As the Federal Reserve continues its easing, the S&P 500 in recent weeks has continued to see a rise. But we're here with Brian Barnier, and he says that you might want to look at it differently. First of all, Brian, thanks for being with us.
Glad to be here, Joe.
So what is the difference between now and maybe, say, 10 years ago of the relationship between the Federal Reserve, the central bank, and how the S&P 500 reacts?
Sure, it's actually even more recent than that in some ways, because we're used to thinking about fundamentals as driving the S&P 500, and particularly in this climate, we're looking at revenue, the price to revenue ratio, because revenue is scarce. Revenue rules in this environment. So that's what a lot of analyses are based off of. Now, what's happened more recently is with the monetary policy, that's become more and more of a contributor to the overall level of the S&P 500 or the Russells or pick your favorite index. And we look at that as something that's changed dramatically just since January. Why? It's because the new Fed 45 went into play. Another large-scale asset purchase program focused on Treasuries.
Right.
No sterilization. Now, this is more like the ones from 2009 and 10, 11. But now, what's very different is that the lower risk asset classes are filled up. If you think of this as a fountain at the top filling up, and then it cascades down and cascades down. So last time, they spent about $900 billion and got about 11 points on the S&P. This time, they spent only $100 billion since the beginning of January, maybe a little more today, I got to check. And we've seen 5.8% up in the S&P. Now, you don't necessarily attribute that all to it, but that's the kind of magnitude of difference in multiplier we're getting. So that's $800 billion in market cap for $100 million in Fed action. That's dramatic.
Yeah, certainly some novel tools by Ben Bernanke and the Federal Reserve with the open-ended asset purchases coming into play back, I guess, at the end of August when they first announced it at the beginning of September. But a lot of people in the gold world say, well, this is reason for me to jump into gold. But you may look at gold as maybe you don't just jump into gold because of the asset purchases. What would you say is the best way for retail investors to look at the yellow metal?
Sure. So the way I come at it is from being an economics guy and a portfolio guy. I am not a gold analyst. But when I talk to those folks, the kind of thing that comes across is that, look, the S&P 500 now is not that measure anymore. It's a lever they're using to drive through to growing labor and through to growing capital and hoping that the economy is going to lift up with it. It's all about the flow of funds that's coming in. This is what Tobin wrote about in the 60s and what Bernanke and a lot of the others are following right now. And the markets are proving out the theory. So number one, they want to watch the flow of funds from asset class to asset class and be anticipating where that is taking things vis-a-vis gold or other precious metals. And in particular, if you can anticipate it like in a future sense, that can be very interesting. Now, the second thing that comes into play here is when you're looking at it, you want to consider how it fits into a portfolio, especially those people who are thinking more defensive. I deal with a lot of retirement income advisors, for example, through the RIA folks. And there, the point is, how does it fit in a flooring that's going to be provided for the retirement? And then, of course, you can do upside with a lot of other things. So now we want to split gold into its sort of cash-like capacity as well as its inflation-resistant capacity, which puts it more like other precious metals and commodities and that sort of thing. So we want to think about how those characteristics play out, and that's what's really important, how that structures in the portfolio. So watch the asset flows and watch how it plays in your other elements of your portfolio and where you think it's going from a future. So you might not just be spot, you may be more futures these days.
Right. Well, Brian, thanks so much for being with us. So you heard it from Brian here. Don't just jump into gold for one reason. There's a lot of different plays on gold. There's a lot of different pressures coming from different directions in this type of economy. Thanks so much.
Glad to be here. Thank you.